Hello, friends. Today we're taking a look at FedEx, ticker symbol FDX. We will be looking at its performance of the stock in the past 5 years, the analyst projections. We will also be looking at some of the current news and last earnings report. We will be looking at the last 10-year revenue, earnings, free cash flow, and book value. And we will also take a look at the debt levels, the dividend history, and we will be trying to find a fair value. Welcome to Money Talks with Martin Reyes, where we try to learn to take care of our money and find great companies at great prices. If you like what you see, if you like my content, please leave a subscribe in the YouTube channel or podcast that you found this video on, and you can also leave some comments. So let's get started. When we look at the FedEx chart, we can see that they had a big drop after earnings, about 12%. It has recuperated a little bit, about 2 to 3%. That's in the last month. It has dropped almost 5%. In the last 6 months, they're up 2%. With the lowest, the October lows were being somewhere around $230, which will be coming back to that year to date, because it's the last year is being up 42%, 43%. This is one of the stocks that I recommended my son to buy after this big drop right here in 2022, and he had a really nice run, and maybe if you bought it, maybe it was time to sell. And that's kind of what we're going to be looking at. In the past 5 years, it has grown 54%, which makes it a little bit above 10%. So that's kind of a really nice growth in the past 5 years, but you probably needed some kind of medication because it has been going up and down like crazy. So whenever we look a little bit more of the details, the 52-week range is between 172 to 285 just before the drop. That's where they were in their high. Analysts think that it is a buy, and they're looking at target price of back to the 285, which will be almost a 13% swing up. I don't know if this price includes some of the revisions ups or down. As of right now, it's paying a $5.04 dividend yearly, which will be somewhere around 2%, 1.99%. And the dividend just went ex-dividend last month. So let's try to determine whether let's just jump into the spreadsheet to discuss more about the last 10-year results. Oh, actually, no. Before we jump into that, I'm sorry. We're going to be looking at the revenues. The last earnings report. The last earnings report, they miss a lot. They miss by 21 cents per share in EPS, and they miss on revenue per share. When you look at the presentation that they have 3 major transportation segments. You have FedEx Ground, the revenues grew 3%. Freight was negative 4%, and Express, and this is where most of their problems is happening because of the increase of full fuel charges and a bunch of other stuff. It went down 6%. And if we jump into page 9, when we look at the operating income, you can see the Ground had a really nice jump to 57%, while Freight had 11%. So there were some cut. They did pretty good there for the cost reduction. They did pretty good in the margins, but Express hit them for almost 50% down. So the problem with them is going to be with Express, and the question is, are they going to be able to do that? Are they going to be able to fix that problem? because some of the revisions, that's where you have to just look at what manager has done. My understanding is the last time that they fail big time, that was part of the issue. There was a lot of costs that needed to be cut, and they started doing much better. So I don't know too much about the company. I haven't read too much. So it will be something that I will encourage you to kind of look into that. Well, with that said, we're going to be jumping at our 10-year numbers. We're going to start with revenue. I have a spreadsheet in which we're going to do the calculations. If you would like a copy of the spreadsheet, is down in the description. Just click the link and it will take you there. In the past 10-year, revenue has grown almost 9%. And in the last 5 years, 5.5%. So as you can see, it has slowed down, and you can even see in the graph how in the last couple of years, it's been kind of getting flat to those numbers. When it comes to revenue, revenue has been very cyclical. However, since 2021, they have kind of maintained somewhere above the $14 a share. So the past 10 years, because it's cyclical, I probably wouldn't pay too much attention to this. The last 10 years have grown 9%. The past 5 years, 52%. And the profit margins, which is where a lot of the problems that they're having right now, it's right now at 4%. Free cash flow is also very cyclical. They have had some negative free cash flow years, which is concerning to me. They had a big bump because of the COVID. Everybody was mailing everything. So in the past 10 years, it's grown 20%, and in the last 5 years, 100%. I will not be looking too much into this. I wouldn't be putting too much trust in those numbers because of the history of what they have been doing. They have a free cash flow margin average in the past 5 years of 3%, which is really, really low. Book value has been growing nicely, almost 8% in the last 10 years, and almost 10% in the last 5. Revenue, return on equity has been it's 15% average in the past 5 years. But sorry that I just got distracted for a moment because I was looking at the numbers, and the problem, this is another problem, because normally I will say, 15, that's what I look in a company. However, this past year, trailing 12 months, is negative almost 10%. And return on invested equity, return on invested capital, is being down this year, is at negative 47%, where their average, and this is what you see here, is being somewhere between 7 to 10%. So that's something that is concerning. Return of assets also has been having some issues. It's close to 5%. So I would recommend that if you are going to invest on this, to do a little more research on this. Of course, this is just my opinion. When it comes to dividends, it's been growing about, in the past 20 years, the past 10 years at 20%, and the past 5 years at 15%. This is why this company is beloved by dividend investors. Payout is at 30%, perfect numbers if you're a dividend investor. When it comes to debt is pretty high. This is something that I would be very, very worried about. It's been growing, but also if we take the last 5-year free cash flow average, and we take this debt and divide it by that, it will take them about 17 years to pay the debt. This is something that it would be very worrisome if I was an investor in this. When it comes to outstanding shares, it's been going down about 2% in the last 10 years, or almost 1% in the last 5. they just announced that they're going to be doing more repurchasing of stock. So that will be something good for you to look. So before we jump into the valuation, let me know, did I miss anything? Do you disagree with any of my comments? Do you have stock suggestions? Just let me know down there in the comments below. And then just like I mentioned before, just remember that I am not a financial advisor. Everything that I say here is just for entertainment and educational purposes only, and you should not be making any financial decisions based on a YouTuber's opinions. So that's my disclaimer. With that said, let's jump into some of the analysts are thinking that the company will grow about 4 or 5% in the next year. Multiple valuations, whenever we look at the multiples that the market has been willing to pay, multiply by the per share numbers, gives us a fair price somewhere between $195 to $262, which give us an average of $228 for fair share. Payback time, if we were to grow the free cash flow 4.5%, that will give us a fair price somewhere between $190 to $350. Discounted earnings valuation, if we take the earnings, grow it at 8.5%, multiply by the 10-year PE of 19, discounted back will give us a number of a fair value somewhere around $173 to $240. I will be not using the owner's earnings valuation for this valuation, so it gives me a fair price of somewhere between of $131, which is, if you look back at the 5-year, it seems like that is the number that has been trading in the last 5 years, somewhere around 100 and well, in the past 3 years, 130 since COVID is being somewhere around there. So I will not be investing in this company. It has too much issues, and I think there is a better stock over there. If you wanted to do it for dividend investing, I will probably put at least a 15% margin of safety, buy it a little bit under $200, or if you're thinking of a swing trade, that might give you a 30% possibility if it goes to where the analysts are thinking that it's going to go. So with that said, I hope that you liked the video. Leave a comment below if you have any questions or any thoughts, and I hope to see you in the next video.